Gracias por acompañarnos. No les voy a quitar mucho tiempo a manera de introducción, pero bueno, pues como saben, AllianceBernstein es un socio nuestro, es uno de los asset managers más grandes del mundo, con unas capacidades de análisis impresionantes. Y bueno, la idea es que Richard Brink nos platique un poco el Global Market Outlook de la empresa, pero bueno, antes que nada quiero presentarles también a Miguel Rosenstroch, que nos va a dar la introducción formal de Rick.
Gracias, Duke. Buenas tardes a todos. También quería agradecerles el tiempo, la oportunidad a los que están aquí presencialmente, y creo que hay varias personas que están también subidas al webcast. Así que bueno, darles la bienvenida. Creo que va a ser un rato bastante agradable, bastante informativo. Y antes de pasar a la presentación de Rick, del speaker, quería comentar un poquitito también, como dijo Duke, sobre la relación que tenemos con GBM. Es una relación que data de casi 20 años de trabajo juntos, trabajando juntos siempre con una misma filosofía de recomendar, ayudar a las personas con las cuales trabajamos a encontrar buenas soluciones de inversión, a generar buenos resultados para los inversores. Creo que eso es algo que tenemos muy en común, lo quería resaltar. Mi nombre es Miguel Rosenstroch, estoy en AllianceBernstein hace 23 años, soy el CEO para la región, o sea, estoy a cargo de todo el negocio institucional y también a través de socios como GBM para Latinoamérica, y también el negocio internacional desde Estados Unidos para clientes de Latinoamérica. Como firma AllianceBernstein, creo que la conocen, pero brevemente comento, es una compañía de gestión, de investigación y gestión de inversiones. Lo único que hacemos, lo único que nos dedicamos, manejamos alrededor de 900 billones de dólares o 900 mil millones de dólares para clientes institucionales, personas físicas, alrededor de todo el mundo, en estrategias de inversiones muy diversas. O sea, tenemos capacidades tanto en renta variable, en renta fija, en alternativas privadas, en soluciones multiactivo, etcétera. Así que es un poquitito respecto a la firma. Lo que vamos a hacer hoy, el presentador va a ser Richard Brink, Rick, con el cual también tengo una amistad, una relación hace 22 años. Fue una de las primeras personas que yo recluté para traer a la compañía, así que no sé si he hecho muchas cosas buenas, pero una muy buena fue traerlo a él, a la compañía. Y lo que va a hacer Rick, yo un poquito como anticipación, va a ser una presentación sobre economía, mercado, oportunidades, desafíos en lo que se trata de invertir hoy en día. Pero antes de hacer eso, él es un estudioso también de la economía, de la historia. Va a hablar un poquitito de dónde venimos, sobre los últimos 40 y tantos años, ¿no? Porque creemos que es importante entender el paradigma presente, también entender cómo llegamos al paradigma presente, y con esa información luego empezar a pensar un poquitito en el futuro, ¿no? Hablar sobre métricas específicas económicas, expectativas de mercado, etcétera, y también cómo buscar mejores soluciones de inversión, cuáles serían algunos de los factores, algunas de las, como comenté, oportunidades que creemos que todavía son interesantes. Así que ese es un poco el plan. Creo que vamos a tener oportunidad para hacer preguntas en algún momento, así que bueno, los dejo con Rick Brink, que es nuestro Chief Market Strategist, o sea, el estratega de mercado para AllianceBernstein, y que va a ser el encargado de compartir nuestra visión. Así que de nuevo, bienvenidos, muchas gracias por el apoyo, por la presencia, y bueno, lo llamo a Rich.
Hola. Before I begin, thank you for letting me do this in English. Intento aprender español, pero con Duolingo. Entonces, no estoy bien. But I will keep practicing. I will keep practicing, I promise. This presentation was born 10 years ago. It's continued to age like a book, adding chapters over the years. And it was created when I became the chief market strategist. Most of my career is in renta fija as a fixed income portfolio manager on the global bond team. And so bonds are mi corazón, right? Okay, sorry, in case she's listening, Mi esposa es mi corazón. Pero renta fía segundo. Now I'm just going to tell jokes. I'm done with my presentation. All right. Why did I create this? When I became the market strategist, I was asked, what's my story? What do I want to say? And what I wanted to say was, in a developed world where returns and economic growth are moderating, how can I think about investing in a way that increases the probability of retirement plans working? Yeah? Because we became addicted to a period of incredible returns. This is a story of where those returns came from, why they went away, how we kept those returns coming for a long time, and what it means now. In about 20 minutes, we're going to take a journey that goes for 45 years to bring us up to today. Listo? Okay, all right, let's do it. All right. These are the chapters. Anytime I present this, I get up on stage and I say, this is the S&P back to its inception in 1957, the price level of the S&P. And I would say to audiences, if you could draw a line anywhere where you say, what happened? Usually I get one of two choices. The first is somewhere around here in 2009, but the most common, I won't forget you over here, I promise. But the other one is here in 1981, because the line starts its long liftoff, yeah? And there's a reason why that line is picked. If I draw a dotted line between it, the S&P over its life has averaged 10+% per year. Pero if I put that line here, it's 8% per year on this side, and it's 12% per year on that side. So if you liked 1981 as your choice, you did, that's a great choice. Yeah? What this means is your money doubles every 9 years. The rule of 72. Your money doubles every 9 years. On this side, your money doubles every 6 years. So in 18 years, your money doubles twice or 3 times. 1 million becomes 4, 1 million becomes 8 in 18 years. Increíble. Yeah? But there's more. If we want to understand why it is, the first thing I need to do is put treasury yields there. What happens at that point? The first big thing is treasury yields. Now this is so many interesting things. We're going to talk about how we get there. In order to get to this point, what's about to happen is treasury yields are going to fall. Markets are going to do really well. But in order to get to treasury yields this high, we needed the 1970s. We needed the inflation of the 1970s. We needed, in order to, I learned this word today, montaña rusa. See? In order to get this part of the montaña rusa, where we can go, whee, right? We have to get to the top. And if we can, we want the top to be really high. So you needed something historic, something incredible. And we got the inflation of the 1970s to create that peak. We didn't know it then, but we were about to have the greatest bull market in modern history because of this tent. And if I'm putting up treasuries, I'm going to give you 60-40, stocks and bonds. It wasn't just stocks that were great, of course. 7% per year on this side in a 60-40, 10% per year. So the S&P in its life, 10-something% per year. In this chapter, a 60-40, 10-something% per year. But we're not done yet, because there are many chapters in that book. There are 6 chapters on that side, and the longest chapter is the first. And I call it the fundamental super cocktail. You know cocktail? Yeah? By the way, I learned to love margaritas My wife is from Germany. We've had au pairs for 10 years. 2 have been from Mexico, 1 from Oaxaca, and that family is our family now, and now 1 from Merida. Yeah? But it was the one from Oaxaca, Violeta, who taught me that if you're going to have a margarita, sugar and salt, no. It must be tajin. So I am addicted to tajin, and I have gone to restaurants in the United States and ordered a margarita. And I said, but with tajin, please. And they said, no, we only have salt or sugar. And then I'm like, okay, I'll take a Coke. I can't drink a margarita without it. Okay, sorry. So let's get into our cocktail. This period through here that we're going to break up right now exists between 1981 and 1999. So 10.6% for the S&P for its history. 12% from 1981 to 2025. But in the 18 years that start our book, the S&P would average 18.35% per year for almost 20 years. Holy cow. Your money doubles every 4 years at 18%. That means in 20 years, your money doubles 5 times, or 1 million becomes $32 million. Just think about that for a second. How did we get that kind of returns? And by the way, S&P over its history, 10%. Traditional 60-40, 10%. During this period, bonds alone did 11% per year for almost 2 decades. Meet the fundamental super cocktail. The fundamental super cocktail is a collection of ingredients. Como una margarita? It's a collection of ingredients that no one planned. No one said we're going to do this or this or this. It just happened. Yeah? You too can have a fundamental super cocktail that creates these returns, but you're going to need some very specific ingredients. First, unfortunately, desafortunadamente, you're going to need a world war. You're going to have to plan ahead because we're going to need a lot of babies to be born. So that by 1981, the largest population in history will enter its peak earning years of 35 years old and be followed by all the rest of the baby boomers every day for 20 years. The largest working population in history at its most productive, with female participation in the workforce at its highest of all time. What is GDP? People and productivity. This ingredient alone would be incredible, but it's not alone. We also got globalization. This is the rise of China, which we could talk about forever. Ping pong diplomacy. Ping pong? Ping pong diplomacy. You ever see Forrest Gump? Ping pong diplomacy. Automation, the birth of the digital age in 1983, the internet, Microsoft Office, all of the things that would happen from tech. Also, unbelievably important to markets. Again, no one planned this. And of course, the top of the roller coaster. Globalization and automation would change inflation in goods and turn it negative for 2 decades. Yep. Incredible. However, oh, and the story, by the way, quick side. So how do you see it? There's my roller coaster in inflation. As that comes down, the 10-year Treasury yield slowly comes down over time. And valuations, the P in PE goes up. These are Shiller PEs. This is a 146-year-old series. Look how low it was in the early 80s, around, see the level here on the other side? And by the time we got to 20 years, it had grown to 45. It had grown by 9 times. 9 times in 20 years, valuations. But the thing was, after time, these ingredients started to fade. Rates would be lowering. The oldest baby boomer would start to leave their peak earning years, one by one, for the next 20 years. The productivity gains that we had enjoyed because of everything had started to smooth out. Yeah? And as an aside, to make up for the lack of natural growth, we started to grow our debt levels, push multiples higher, and we planted the seeds of populism and anti-globalization as an extra bonus. I have the terrible job of creating the firm's presidential election deck every 4 years. It is the worst deck anyone should ever have to create because everyone hates you at the same time. And they hate you because you try not to be political. They want you to be angry and political. But there's a reason why I can explain elections from this. Because when you create that much behavior in markets, that much strength, and you start pushing markets and asset markets are driving wealth, you start to create a big gap. When it comes on the back of globalization and automation, blue collar, factory jobs begin to get impacted. This is the paycheck proxy. It's an estimate of the US paycheck. Take all the jobs times the amount we get paid per hour, the hours we work, multiply them, and get a proxy for the paycheck of America. This is corporate profits. Do you see how it kind of sits together? And then this is in the 80s again. And this lifts off and pulls away. This is real income growth, inflation-adjusted income growth for different income groups in the 35 years before 1980 and the 34 years after 1980. Hello, my friends down here. So, take a look at the growth in incomes for middle and bottom earners here in the 34 years before and after. Look at the income gains for the top 0.1% before and after. This is how much extra money you make if you have a college degree instead of no degree. That doubled in 20 years. When? From 1980 to 2000. Yep. This is the Gini coefficient, the famous Gini coefficient. My eyes are, what's this year? 1980. 2000. Okay? I can explain every election in the developed world on wealth inequality and the two prescriptions to fix it. Redistribution and raising the drawbridge. This is where it was born. But after this starts to fade, we start replacing it with debt and multiples. This is one of Warren Buffett's favorite visuals. Household net worth, the value of stocks and bonds, houses, divided by GDP. Yeah? For decades, it stayed in a range. And then all of a sudden, into the tech bubble, into the global financial crisis, and finally, and this is really important, into the first and greatest stimulus since the Great Depression in our era, the birth of fiscal and monetary, all the support into markets to save the banks, to save the auto industry, et cetera, et cetera. What does that look like? This is the Fed's balance sheet, buying stuff and assets, and this is the S&P. I have always said that I don't like modern art because I don't understand it. If you put a vacuum cleaner in a cube, it's just a vacuum cleaner in a cube. I don't understand it. Maybe it tells me about hardworking people or people that don't like dirt. I don't know. But this is easy to understand. Put a lot of money into markets and markets go up. Take it away and they don't. Yeah? These were my first 3 chapters. The fundamental super cocktail, the greatest bull market in world history. When it fades and we push too hard and we get 2 crises, the tech bubble and the global financial crisis, and as a result of the global financial crisis, for the first time in the modern era, we jump to the rescue with massive fiscal and monetary to save the markets. Markets not saving themselves, us saving markets. This is fundamental. This is gearing. And that story, by the way, after that, I said, okay, returns are going to be more modest. Fundamental super cocktail's done. Stimulus is done. I was right for 2 years. Why was I wrong? Because this is when Trump's first administration began. After the election, we got a new form of massive fiscal and monetary support. But this time, not because of a crisis. We got the Trump tax cuts and the Fed's reversal. In 2018, the Fed said they were going to keep raising rates. Jerome Powell said we have a long way to go. Markets hated it. Within 4 months, he had changed his mind and said we're going to cut rates. This combination was another cocktail. Look at the returns for these 2 years. Look at the returns of stocks after we put in the tax cuts and we reversed on the Fed funds rate. In 2019, when the Fed reversed, the S&P was up almost 30% that year, but earnings growth was 0.6%. And then I said, that's it, that's over. There's no way the kind of thing that would have to happen to create even more fiscal and monetary to drive markets even higher, I just can't imagine it. COVID. I accidentally caused COVID. Here we go again. This is a package so large that it made the GFC look like nothing. We bought everything that wasn't nailed down, as we would say back home in Indiana. And so here we are again. Remember, for 2 years, we saw these kind of returns, and suddenly we were back to 17% in equities, 14 and change percent in equities, not on growth, on gearing. So what does it all look like when put together? One super cocktail that set the tone for markets, and gearing, and gearing, and gearing. That's what we've been doing in markets for 45 years. Now, why does that matter? I told you, when I became the strategist, I wanted to improve the probability of retirement success. If you retired in 1981, stuff was easy, like muy fácil, right? You start with $1 million. Who's Bengen? Bengen is a financial advisor who in 1994 said, I think you can take out 4% every year in retirement and adjust it to inflation, and it should last you for 30 years. You should be good. Someone in 1981 retiring with $1 million hoping it would work. I hope my million lasts. Instead, would start with $1 million and 30 years later, after spending for 30 years, would have $13 million in their account. From 1 million to 13 million. But returns are falling. And they are falling. And as that happens, it makes it more and more difficult for retirement plans to work because there's no buffer, no cushion if things get bad. How does a retirement plan die? You have a big drawdown in markets right around the first 10 years you retire. Assets go down. You have to sell them to pay for retirement, and you fall behind. That's how a retirement plan dies. Okay. But the other thing, I'm just going to skip these guys. The other thing that's really important about gearing returns, about stimulating markets through purchases and everything else, is that what it does is it pulls returns from the future and pays them to you today. That's what happens because you're not growing to earn them. You're increasing valuations, and so you're taking returns from the future. If you want to see what that looks like, 2019 and 2020, 2 very different years. There's pre-COVID, 2019, and then there's COVID, 2020. See? 2019 was the Fed's reversal, the 30% returns with 0.6 earnings growth. 2020 was the stimulus that starts to hit. Okay, pretend you don't see this. This is not here. Agreed? It's not, sorry, I'll be right back. It's not here. Ignore this. If I showed you this kind of GDP over a 2-year period, and I showed you this kind of earnings growth changes, would you have said to yourself, I think the S&P will be up 56%? Welcome to the age of gearing. And so when we would run our models to estimate future returns, in 2008, it was here. 2018, it was here. 1 year later, because of the Fed's reversal, it was here. And then we got COVID and all the support, and it fell all the way to here. By the way, the probability of a plan failing here was 3%. Here, it was 27%. Here, it was between 35 and 40%. If this was all that happened in COVID, it would have been an important story. But this actually isn't the most important part of COVID, the big package and the returns coming down. The most important part of COVID, just a moment, is right here. For 10 years, the US Federal Reserve could not get inflation to its 2% target and hold it. They couldn't make it happen. 1.8 was the average over this period. They could not make inflation happen. Are there any fans of Marvel movies like the Avengers? Just lie to me if it's not, okay? Because my whole story doesn't work unless you like the Avengers. Okay. The Avengers have all these villains. Thanos, Loki, right? All of that? Okay. The thing that I didn't expect to get from COVID is the inflation league of supervillains. Of all the things I've studied in economic history and financial history, this is one of the most remarkable I have ever seen. And nobody really thought, well, not a lot of people, I think, thought of it this way. We couldn't buy 2% inflation. We couldn't get to 2% inflation. And then the greatest villains of inflation in history, certainly American history, all showed up again. But they showed up one after, like a Marvel movie, one after the other, after the other, after the other. Global pandemic, reopening, 1918, 1919, European land grab, invasion, 1945, the housing lock-in, rates come way down, we refinance our mortgages, they go back up, and it locks up the housing market. People can't afford to buy, people who own the home don't want to sell because their interest rates are low. Last time that happened, 1981, and then global tariffs, 1930. Average distance in time to when these showed up, on average, 82 years. 82 years away from the last time each of these showed up on average, and instead it showed up back to back to back to back to back in 5 years. And we got this. One of the 3 highest readings of inflation in American history when we aren't at war. And so the story now in portfolios is, what do we do in this world? Sorry. Because what happened when inflation went up is the Fed raised rates, as we know. And so today, we have a story of inflation running above the Fed's target. It's been there for years. We have the Fed funds rate at a high level. And so as investors, now we get into the capital markets outlook, because there are 3 things that jump out at me from this. One is, in those portfolio models that I study, the number one reason why bonds' probability of success has jumped up is because of bond returns. Because bond yields have risen, and the models look at it and say, oh my gosh, half of my portfolio now can do something. That's the major driver. So what's my first recommendation from a capital markets perspective? Take duration now. Manage the duration. Take an approach to capturing yields now and having a duration exposure for capital gains should interest rates fall over time. If inflation continues to fall as the supervillains all exit eventually, do rates come down as inflation falls, and are we right back to wishing we had high yields? Now, I know this doesn't really matter to you in Mexico because you have these nice, juicy 7% yields. I get it. But in the US, that's more than we get in high-yield bonds. That's more than we get in junk bonds right now. But in developed markets, we need to capture this right now. The second is have an approach to inflation in the developed markets, if it is going to stick around. I don't think it will, by the way. And number 3, in equities, this becomes a story of the S&P 493 versus the Mag 7. Because models and markets are being driven by the past several years of AI performance driving the S&P, and then we have all the rest. All right, could we switch to the capital markets outlook? And I'm going to bring this home. Is this okay so far? Are we doing okay? You sure? Yeah? Okay. We can just talk about Kevin Warsh as the Fed head if you want. I mean, I'm happy to do that too. This last part will be pretty quick, but I want to set the stage for the inflation we left off on. So our League of Supervillains, I'm just going to fast forward through. Oh, by the way, returns, just let me stop here for a moment. Just to set the stage for 2026, the returns for the S&P 500 in 2025 are down here at 18%. You see that? Do you see the title of the slide? This was the strongest 3-year period for the S&P 500 since the buildup to the tech bubble in the 1990s. The strongest 3-year period since we created a bubble that popped. Yep. Strongest 3-year period. Okay. In the capital markets outlook, because of COVID, we made changes. I've been leading the capital markets outlook. This is my 18th year. And the macro section on economics used to be very short. There wasn't much to talk about. Growth was inflation was low. We talked about investments and how to get a little bit more. But COVID changed it. And we had to bring out what we call the Trinity, the thing that the Fed and other central banks have been watching for years: labor, inflation, and growth. At different points in the last 5 years, each of these have led. But the one that is most in focus right now is the labor market. But I'm going to start with a couple of quick observations on growth. One, this is a pretty concentrated economy right now. Yeah? We are being driven by business spending and consumer spending, but it's very specific. In business spending, it's driven by AI-related spending. This chart takes out AI spending from GDP in the US, and if you do, it goes to almost zero. Just take out AI spending, and GDP goes to zero. This is AI-related CapEx. Look at the line slope. I can't even make it happen like this. It goes like this. I got into powerlifting, levantador de pesos, something like that, and now I can't move my body anymore. So, but this. And on the other side is consumer spending. The top 10% of American consumers now account for 50% of consumer spending. So AI CapEx dominates business spending, and the top 10% of earners dominate consumer spending. That's a fragile GDP. Yep. That's the story behind GDP right now. I'm going to skip this one, and I'm going to talk about labor. The labor market is also pretty fragile. This is the quit rate and the hiring rate. We have what's called a no hire, no fire economy right now. We're not really hiring anybody, but we're not really laying a bunch of people off. But recent news like Challenger have said maybe we are starting to accelerate layoffs. So this is a very uneasy balance between not hiring and not firing that we have to watch. And remember, GDP is about spending. That's how we measure GDP, is by what we spend, yeah? The expenditure method. This, back to the household paycheck proxy, the estimate of the nation's paycheck. This is inflation adjusted. For the last several years, it's been around 2 to 2.5%. This is a really healthy level. Usually GDP is kind of in line with this because most of US GDP is the consumer. But notice this. Now it's come back up a little bit, but on this point, the inflation-adjusted wage gains, the growth in wages, was zero. This is a pretty tenuous backdrop. So, for me, from an economic perspective, goods, inflation. Inflation is coming down. Like the Trump administration the first time. Once tariffs made it past 1 year and fell out of the data, got taken out of the data, inflation disappeared. We believe that that's, unless something else happens, is what happens this time too. The way inflation is calculated, it's 12 individual months of data. And every month, the oldest month goes away, and the newest month takes its place. So, 11 months, 11 meses, are the same, el mismo, and one is different. Yeah, it's a slow-moving number. But in the first Trump administration, once the tariffs were put in place and no more came, after 12 months it was gone, and inflation showed it as out of the system, and the Fed could act accordingly. All right, so we think the same thing happens, and during COVID, remember the lock-in effect, that caused housing prices to go way up, that drove inflation, that also is coming down. So 12 months from now, unless something changes, inflation in the US is headed lower, and maybe meaningfully so. Powell said if it wasn't for tariffs, the last supervillain, if we had all the rest, but we didn't have that guy, they believe at the Fed inflation would already be down to 2.1%. If that's correct, now we're just waiting on the months to pass until it exits. Okay? All right, let me stop for a second here. Any questions? Any comments? So far, so good still. A little more? Okay, that wasn't very enthusiastic, but
Yes.
yes, thank you. I'm like, okay. Yes, please, thank you.
But at least for this year, when you start the year, we had higher tariffs. So the 2.9% or 3% inflation you saw last year is going to have to peak a little bit this year, and then next year you're going to have it falling. But then you're going to have a higher inflation this year, and I'm just looking at your rates now.
Mm-hmm. See?
That does not check. So that theory does not check with falling rates.
So
you're going to have them higher this year because of tariffs. Just for this year.
see, so if we're taking the tariffs from last year, 2025, and they started getting put into the system, every time it shows up, it takes 12 months until it goes away. So please, go ahead.
The average was 2% last year, and then I think the average this year is like 10. Or am I wrong with that?
No, inflation?
Yeah.
No, it was,
Tariffs.
oh, on tariffs, yeah, yes. But those tariffs that are now at 10%, and that started into the back of last year, it's like an average through. If we look out 12 months from now, whatever it is right now, 10% right now, 12 months from now, that technically goes out. It requires, as my wife would say, paciencia y fe. Yeah? My wife, because she's European, she speaks like 5 languages. Yes, sir.
I remember seeing a chart with the coupling of the Standard & Poor's 500 and employment in the U.S. around the 2022 when IA made a break in. So Standard & Poor's got higher and employment fell down. I didn't see that reflected here. Is that something that's happening? Was that wrong?
No, you had a few things happening at the same time. So it's right in 2021 where we start to really get the inflation, and then into 2022. We're in the middle of our league of supervillains, but that's also a period where the economy started to open up. We left our house. We were able to eventually take our masks off. We started to get our shots. And so we started going back to work. And so employment numbers do show that. And importantly, wages went like this. In the United States, places like McDonald's or Burger King would offer big bonuses just to go to work because we'd been staying home, right? In the beginning of COVID, did anybody ever watch Oprah Winfrey when she gives out free stuff on the show? In the beginning of COVID, for me, it was like, and you get a Peloton, and you get a Peloton, and you get a Peloton, because we're in our house on our bikes and we don't go anywhere. But when we open up again, and now we can start going out, that also triggered employment. It also uncorked, some of the market behavior, consumption in that part of the economy that kind of closed down. So like, oh, people are going to go shopping at restaurants and everything else again. My au pair from Merida, as we took her to different restaurants. We're like, oh, we're going to go to this place called Texas Roadhouse. And she's like, yeah, we have one in Merida. We're going to go to this place. No, we have one in Merida. Yeah. But as people went to work and things opened up, that also triggered a belief in my good friend started investing in restaurant stocks early on before it opened up. Yeah. And then AI also starts to catch its run right? So 23, 24, and 25 was that 3-year period that was the best since the tech bubble buildup. So you're right on all of those. They all kind of show up around the same time. Reopening, the AI trade starts to move, all of that, yeah? So you're absolutely right. Okay, so what do we think is going to happen? And then we can talk about markets and close it. Our view for, you can see our views for growth in 2025 and 2026, for inflation, for rates, and for longer rates like the 10-year Treasury. If we take the US in the middle here, growth is near trend. Same thing for next year. Inflation, we have dropping down into the mid-2s by next year. And we have official rates coming down. Now this, by the way, right now our chief economist is at 2 cuts, but we discuss this all the time. It could be between 2 and 4, in our opinion. We can make a case for 2, 3, or 4 this year. I know that's a big difference, but this is the idea that over time rates come down. And right now curves, treasury curves, think of this as the Fed funds rate, 2-year treasuries, 30-year treasuries, is very steep. If you're a bond person, you love steep yield curves for a lot of reasons. So taking duration now is not just about a high level, it's also about the shape. Those are 2 very interesting opportunities until I think they go away. Yeah? Okay. Let's do this crowd participation. Am I still okay, time-wise? Yeah? Yeah? Okay. Just want to make sure I'm not overstaying my welcome. This is now the crowd participation part. We're going to do the Macarena. No, we are not. No. Okay, let's talk about AI. Specifically, I'm going to focus on the Mag 7. How many of you think in the next 3 years, AI is strong to very strong? Those stocks over the next 3 years, there's no wrong answers unless it's not my answer. It's going to be really strong over the next 3 years. Okay? Yeah? Okay. Now, we're not going to have any middle ground. There's only here and here. So how many think in the next 3 years, AI is going to take a big stumble? Something's going to go wrong. You and I should go out for a chela. I can make a case for both. But it's the uncertainty as a portfolio creator that I have to defend. I have to participate, but I also have to defend. Do you know the hardest thing as a portfolio constructor to get credit for? Nice job, Rick. The hardest thing is the thing that you protect against that never happens. Yeah? That's one of the hardest things because you give up returns to protect and it doesn't happen and maybe you look silly. I am very big on protecting. My portfolio design is about sequence of returns. If I don't think the level will be high, I think I can win on the sequence. Can I get investments that have good downside protection? Right? That's sort of my area of focus. Okay, so the S&P 493 versus the Mag 7. Okay. Depending upon how you feel about the Mag 7 and AI, because it's dominating investments and discussions and GDP and everything else, how you feel about that influences maybe how you think about building the S&P 493. For me, because I'm a little nervous about AI, although I see the opportunity to, I would have answered to my question, I would have answered ambas, right? But if I want to be an AI, then I can use the 493 defensively. We sort of forgot about some really interesting areas that live inside of the 493. One of my favorites is US large cap quality as a factor. US large cap quality historically, over the last 30 years, beats the S&P by a lot. But it wins not because of how it does when markets are really up. It wins because of how quality is done when the S&P is really down. Yeah?
Have a chart of that?
Not here. I will look at the end and I will show it to you. I can, but before you go, give an email to somebody. We'll send you. We have a whole paper on quality. And specifically, US large cap quality, one of my colleagues has tested quality in different markets. That's the strongest signal. US large cap has the strongest signal of being able to protect to the downside through down markets. Yeah? Oh, yes, thank you. Low volatility. But the trick to, oh, by the way, but there's a trick. Quality is not a metric, it's a characteristic. When I say quality, what does that mean? If I say, Miguel, my old friend, my old friend, also old, and I am 1 year older than Miguel, so that's me. But if I said Miguel is a quality guy, you might ask me how I measure it. Quality is a characteristic, it is not a metric. How you measure quality is everything. In the ETF world, amongst US large cap quality, every year, on average, this is US large cap quality only. Those ETFs, the best and the worst in that year, the difference in performance is between 7 and 10%. One can be up 10, one can be up 0. That's the average every single year. How we measure quality matters, but over time, quality is a great protector inside a portfolio. So is low volatility. So is high yield, US high yield bonds in the equity portfolio as a downside protector. This is a toolkit that we usually don't think of. Tools that protect to the downside, that I can put into a portfolio to lower volatility, especially if I think AI is going to do well and I want to be exposed to it. So one homework assignment, Tarea? Thank goodness. Your homework is to think about, in your investments in your portfolios, how valuable downside protection would be. How might I want to incorporate that into a portfolio? Whether you do or you don't, just as an exercise. How might I combine these ingredients to try to create some level of protection but still participate? Yeah? I think over, and this is my final wrap up here, I think over the next few years, there are going to be a lot of things that take place. We are going to make our way through the entirety of the administration. We have the midterm elections later this year. We have a lot of question marks around global supply chains, global relations, how that plays out. I'm happy to talk about that in Q&A if you'd like. But we're also going to have a lot of questions answered around AI. Look, I believe that 10 years from now, we're talking about AI being incredibly important. There are lots of things to talk about with AI. How does AI win? What about labor? What happens to jobs in AI? There are lots of ways to talk about it, but I think over time, AI is transformative, and 10 years from now, 20 years from now, it continues to grow. Look, this is important. In the build-up to the tech bubble, all that tech, the internet, all of that, we didn't suddenly get really skilled overnight. Microsoft Office came out in for my company, we got Microsoft Office in 1995. Everybody didn't suddenly know how to use PowerPoint or Excel or Access or use it really well. It took 15 years for people to get better and better, for it to go across the entire firm. AI is going to be the same. How many of you think that on a scale of 1 to 10, I'm going to out people. How many of you feel really good about using AI right now? Like really good. You feel like I've really got my arms around it. Okay. How many of you are like, on a scale of 1 to 10, maybe I'm a 1, 2, or 3 in my AI journey? Okay, I'm right there. I have a colleague who's a senior software analyst. He was the first person to bring in ChatGPT to our firm. He writes prompts when he writes questions. Do you know how many words are in the prompt? 1,000. 1,000 words in a prompt. I'm just like, hey, how you feeling today? Right? 1,000 word, very specific prompt. And then we go from AI to agentic AI. At my firm, they want to record me in a video, so they get my likeness, my avatar, record my voice. Then they want to take every time I speak, like here, they would record it. Every CMO, every blog that I write, every paper, every podcast, every webinar, take all of it and put it into an agentic AI. And this is so creepy. This is so creepy. Somebody can walk up to an avatar of me and say, AI Rick, what do you think happens to GDP in 2026? And AI Rick is going to answer based on everything that's been fed into that. Agentic AI, we have not even begun to try to use agents. AI is going to grow for 20 years. We were laying people off at AllianceBernstein in 2011 and 2014 that were still because of the tech buildup and the gains that we made. Those of us that are old enough, it was the jobless recovery after the tech bubble. Businesses were doing well, but we weren't hiring because we were realizing all the efficiencies, all the productivity we'd gained, but we weren't laying people off when the market was doing this. But we did after. It takes a long time to realize those gains, and AI is going to be transformative in good and bad ways. We have to be really aware of it. But on that journey from here to there, how can we try to protect on the outside around that AI journey as we go through it? Because one of the most powerful things we can do in a portfolio is protect against things that actually do happen and then have the ability to rebalance into cheaper markets. Those can produce really good gains. So it's hard to take credit for the things that you protect against that never happen, but it is one of the most powerful things when it does. And so if we can thoughtfully think about the 493 maybe in that way, and marry that to AI, maybe that's a way to think about go forward. Okay, first of all, you've been incredibly kind to sit here patiently and let me go through all of this. I am very, very grateful. But now it's time, if you'd like, for me to ask you to ask me if there's anything that I can tell you from a question perspective around anything within markets, macro, policy. We can still come back to Kevin Warsh. I have a lot to say about that guy. What kind of questions can I answer? Yes, sir.
Just to give the microphone for the questions. So those on the
Thank you. Thank you, Rick, for the presentation. Really nice one. You were talking about this unstable labor market. And I think we have seen right now, lately, kind of weakness. An overreaction in the rates with barely weak signs of labor market. So I think that's like kind of an overreaction because the rates moved like 7 or 8 basis points with no real weakness in the labor market. So my question would be, what would you think is the key sign to realize that there is a structural change rather than a short-term noise? Thank you.
Thank you. That's a great question. Thank you. Okay. So we have seen some signs of weakness, but they're usually reacted to, but remember that the government shutdown in the US did away with some of those labor reports. So we had to wait to get some of them. And we were relying on more corporate data, the private sector. So like challenger surveys, things like that, to get some of the labor data. We just had a really weak challenger one come out, for example, that the market reacted to. But at the same time, we're getting the same kind of stable labor story. That's the bigger one. Markets overreact today because I believe that they've been overreacting since 2008. And the reason I believe that is it was after 2008 that we had the rise of more advanced investment strategies. So we all know 60-40, the stock-bond combination. One of the things that happened in 2008 is when the market went way down and bonds didn't go up enough to help, people said 60-40 doesn't work. It didn't offset. It didn't protect. And I would say, build a better path. Me would say, of course, bond yields had gotten so low that they didn't have enough power to offset. They went up, but they went up by that much, yeah? But one of the things that happened in products, in investment products, was the rise of different balanced, risk-balanced, VAR-based, risk parity, new forms of balance. And they rebalance based on changing volatility metrics. So we have that one side, and then we also have during this period the rise of algorithmic trading, momentum-based trading. There's a reason why there's so much momentum in markets, because so many models that trade and trade with bigger and bigger and bigger volume, are pushing until something turns it back over. Think of silver. Silver was on the day that Warsh was announced, right? Silver was going to be, it's doing this and this and this and this and this, and then boom. In COVID, we had 11 days in a row where the Dow Jones was up 1,000 or down 1,000 every day for 11 days. We live in a world where, because of momentum-based trading and the amount of dollar assets in it, that highs are higher, lows are lower, and turns are faster. Yeah. And so we just see it every so often. You'll see something just rise until it turns, and then it goes like this. And so trying to find the real level of value, it's almost like you have to break momentum's impact to ultimately find what I think the real value is. But so far, labor overall is like, it's like, I don't know, it's like one of the acrobats that balance on a tightrope or anything like that. It feels like labor is just kind of right here, right now. And our base view is that it's probably okay. There's enough consumption. GDP, that's why we have the number we have. It should be around trend. But there's a decent amount of downside risk in it, which is why I keep coming back to the S&P 493 or the use of duration. Because if it turns over, rates will come down faster. That's when rates will come down quickly. And my biggest, I've been on different programs, and I remember when the 10-year Treasury got to 5%. I was on a show called Josh Brown and the Compound, and we were talking about treasuries. And I said, I'm not afraid of a 10-year Treasury at 5%. That doesn't scare me. A 10-year Treasury at 2% scares me, because now I don't have the offset. I don't have the income being generated. Part of my, if inflation is 2%, then my real yield is 0 for a big chunk of my portfolio. So when things are good, I don't make any real returns. When things are bad, I can't play enough defense. Yeah? So it's because of that kind of uncertainty around it that playing this kind of defense aggressively, making sure we have duration, making sure we're taking kind of control of it. Because I can paint a picture for you where we're fine through the year, growth is solid, it's trend for a while. But we talk about the cracks all the time. And we have cracks in macro, we have cracks in policy that could be announced tomorrow. Yeah? And we have cracks in the AI space. Right now, it's a lot of circular spending, and it's forced spending. If anything slows that down, and it starts to do this, then it can feed back up through the entire chain. And again, I think AI one day it's already transforming. I think it's incredible. But how we navigate the next 3 years in AI, I think, is a really, really big part of portfolio design. Thank you for that question. All of my answers will be 30 minutes, by the way.
I would like your opinion on energy generation keeping up with AI investments. I think that's a big bottleneck, and it's not easy to answer, but I'd like to know your opinion.
No, I'm exhaling because, and by the way, bottleneck is, we talk about log jams and bottlenecks all the time. We did, one of the series that I do is called Disruptors, and we did a 2-part series on the supply chain of AI. And a big part of the first one was on energy. And all of the analysts and PMs, they talked about log jams and bottlenecks. We have a real problem to solve. Energy generation at the level that we expect it to get to. Forget where we are now, but where we expect it to get to, we have a lot of work to do. One is this whole, look, I know in the US we've had, policy changes around renewable energy, but I think the world is a lot more like Spain in the respect that it was 2-3 years ago where one of our sell-side analysts wrote a paper about Spain being an example of a country that uses solar and wind and sun and coal and gas, all of it. Now, what that means though is, one, we need to be able to generate enough energy from all the sources, which is going to be hard enough. In the United States, we talk about doing nuclear. In the United States, instead of traditional plants, we're going to do SMRs, the small modular reactors. Yeah? But the thing is, the US stopped doing nuclear a long time ago. We wanted to go away from it. 3 Mile Island and all of that stuff. So we've walked away from nuclear. Now we're trying to catch up. In wind, when I did this, a handful of months ago, wind turbines from US manufacturers were back ordered into the 2030s to get the turbines. So we have a supply chain issue. We have a logjam and a bottleneck and a logjam and a bottleneck around energy creation. Now, I will say this. The other side of the coin is that's why energy generation is an incredible investment. If you can identify the logjams and the bottlenecks, those areas to invest are, it's surprising how much return you can get out of a space like that. Also, remember, many parts of the world have decided that energy security is a national security issue. Energy security is now something we have to make sure we have control of. We have to be able to get our arms around energy. Mexico, right now, is part of this, the whole plan that's being undertaken, right? So we have to get energy self-sufficiency. We have to get access to metals and minerals, right? Those are two things underway, log jams and bottlenecks. So from an investment perspective, think about everything on the supply chain of AI, inclusive of energy, and also the things we need that goes into the hardware. And all of those constitute great investments. But we have a race that we are in right now. We also have questions around water and the usage of water and so many things going on that we're going to have to sort out, and it's going to get messy from an investment perspective. From a human perspective. But there are lots of investment opportunities, and a couple of them that are also really, really interesting to me. One of them is that we need, what we have not had in energy ever, is we need a traffic cop. The police officer that traffic, right? We need an energy traffic cop. When electricity, over 100 years ago, when we established the modern system, it was one kind of electricity. Now, if you're Spain and you're trying to bring this, we actually have to create smart grids that are going to be able to accept the wind when it blows and that energy, accept the sun when it shines and that energy, and be able to route it and traffic it and send it out. There's going to be intense investment opportunities if we can get past the politics as we try to do it. And for that reason, things that you never thought were interesting will be interesting again. Transformers, transponders, these tiny little nothing things that all of a sudden we have a log jam and a bottleneck. So yeah, we have a real problem generating all that energy. The solution is we have to embrace every single type of energy, move as quickly as we can, be thoughtful about how quickly we try to move on energy needs. In the US, we're starting to see issues where the data center needs get ahead of the communities. And we're starting to see little surcharges, extra charges and bills, things like that. There's also now, in the US, we have regulated and deregulated utilities. Regulated, the government constrains them. Think of those as like the bond version of utilities. Deregulated or unregulated utilities for a long time were crap in the US because they were competing with other energy sources that got really cheap. Yeah? But now, unregulated, deregulated is like the great hope because that's the one that one of the Mag 7 can walk in and say, we want a contract. They have more flexibility. So from an energy perspective, we have this whole field of play so that the good side of this is all the tiny little parts that create energy. Understanding regulated versus deregulated, knowing what the traffic grid will look like, knowing the rebuild of the entire supply chain of energy and all of the logjams and bottlenecks. As investors, it's great. As citizens of the world, we just have to slow it down a bit because I already see little cracks in certain places where communities are being, sort of held back from certain energy. It's already being locked up in contracts and there's a reaction. And we're seeing some early elements within water that comes from that. Yeah, is that helpful? Yes. Yeah. Thank you. Depressing, yes, but hopefully helpful. Other questions? Yes, sir.
Thank you, Rick. I would like to know your opinion on the US dollar and its value, and if you think it's going to continue to devaluate in the future, or what will happen with it.
You guys have amazing questions. I was hoping, I hoped that I was joking when I said 30 minutes per answer, and look. So this is one of the most important questions in markets. I mean, the dollar, important different times, but I'm going to choose Bretton Woods in the 1950s, right, where we lock in two things: the U.S. dollar and U.S. Treasuries together. The thing for me has always been that the dollar supported the value of the Treasury and the Treasury supported the value of the dollar. Those were twin assets. If I settled trade in dollars, then I didn't want to sell the dollar and then hurt my currency from an export perspective, then I would put it into Treasuries. The Treasury was a stable, solid investment, right? And so they worked together. I could be the unit of global trade settlement. I could also be the denomination of a risk-free asset that the world recognized, which made it the most liquid market in the world, both the currency and the bond. Yeah? We started to see a little decoupling in that, right? We started to see the behavior of the currency and the bond move away from each other and become less correlated to each other. And that opens up a whole conversation around reserve currencies and reserve currency management and how much of the dollar reserve currency managers hold. I doubt very seriously that any reserve currency manager will not hold the US dollar anymore, but you don't need that to happen to create a challenge. You just have to have reserve currency managers take it down by 5%, and another, and another, and another, right? We saw, I'm sure you all saw the data. You had investors buying the S&P 500 but hedging the dollar. Could you have imagined that like 3 years ago? Somebody like, you know what I need to do? Get the dollar out of here. That's like I'm so nervous about the dollar. I could blow up in a second, right? We never thought that. Now we're hedging the S&P 500. And so the question I ask is, and I've been talking about this a lot today in different meetings, is the things that have taken place as a result of policy and geopolitics, whatever we want to put it into, how far are we that we can't go back? Have we crossed something that's too far to come back from with the dollar? Or are we just one really nasty crisis away from everybody loving the dollar? Are we too far gone that the world still will go back to the idea that they want to own a lot of treasuries? By the way, right now in auctions, we still have strong foreign participation in the auction. But that, that can easily change. You probably saw the headline about China. But in auctions, foreign participation overall is still strong. But the thing about the dollar and the treasury is it directly ties to running your economy and the behavior of your economy. This isn't just an investment, right? It's a big deal in terms of the way trade is acted, drawing a blank. Trade is done. The cool word was not in my head. Trade is done, right? The way trade is done. And And the US Treasury is how we fund our colossal deficits. What's interesting is so many countries in the world run a deficit that they have to fund through debt issuance. We now are competing for somebody to buy our debt so we can continue to fund our deficits. You don't want to be the one that starts falling down the tables. And so again, it's the same thing. I don't believe that the whole world will stop buying treasuries, but if the whole world stops buying about 15% of treasuries at the size of issuance that we have, then that has a ripple effect on yields, which has a ripple effect on debt service, which has a ripple effect on the US budget. So-called involuntary debt service, the stuff we have to spend whether we like it or not, like paying the debt, paying the interest on our debt. I wonder if that, at what point we get too far. Like I mentioned, energy is like national security. You're definitely seeing a world, because of what's happened, in my opinion, you're seeing a world that's saying, we have to make sure we've taken care of ourselves. We have to make sure that we have put some kind of a protective element around us through what we can do or through friend shoring or whatever it is, so that we have the energy that we need, so that we have the minerals and metals that we need, so that we have the access to all the components that make up AI and hardware, because if AI is going to be the future, then we all need access to everything that it takes. And you're starting to see those in different parts of the world pop up in different ways. Mark Carney's speech at Davos, right? The middle countries, if you will. Mexico, the idea of everything that's being put forth, the 5.6 trillion, it's going to get spent. The idea of trying to create highway or road availability to traffic stuff to be super efficient, use AI, get it across the border, and become southern China, which I think, by the way, is reasonably doable. If everything's executed on, you can tell me I'm full of it, you live here, but my belief is if that's executed on, and we can produce that close, it already happens. Northern Mexico's like Chi-Mexico, Chexico, Chinexico. I'll workshop it. I'll come back next year, I'll have it down. So you can just go up and take one part out and have it all set up and have set up the energy around it, set up the transport around it, the logistics, have locked in the ability to produce goods in and of your own volition. Mexico could be legitimately a serious, serious partner and force the United States to be friends. Look, if I was president of the United States, I've said this for years, Automobile Alley is something that a Fed researcher named years ago for automobile production. Canada, Mexico, the United States. Automobile Alley was the path through the cities in those three countries where an automobile would travel as it was produced. If I was president, I would create a production alley that ran from Canada through Central America. I'd run it all the way down the peninsula. I'd run it through every single country over time, because there's lots of labor inside of those countries that if trained up and brought into the supply chain would probably love to be part of that supply chain. Imagine all of the Americas suddenly fairly sufficient. The US can't produce its own stuff. I don't care what anybody says. That's just it's not even a pipe dream. It's a joke within a joke within a joke. But you give me all of the Americas in a coordinated production, there's some really interesting stuff. So at least on paper, as I read about the proposals within Mexico, I'm very encouraged by what that might mean. And I would love, absolutely love, to see that happen. Why did Japan take off? The Takaichi effect. It's the same thing. What's she talking about? We're going to bring chip production back. We're going to do a lot of the tech things here. We're going to get our own energy under control. We're also going to cut the consumption tax. I get it. That's going to spur more consumption. That's going to help GDP. But it's the same thing again. We're going to draw this ring around it. We're going to partner with the nations that we need to, but we are going to take control of our energy and our AI and our production. Expect to see more and more of that as this goes on, whether it's amongst a few countries or those kind of announcements. I just wonder at what point we get too far, where we're beyond the point where we can unwind that again. Last thing I'll say on this answer is, remember in the first administration that there were 3 different trade agreements with China, various ones, that had European signers, 3 different Chinese trade agreements. And the only thing that stopped it was the no limits partnership announced at the Winter Olympics that then was followed by Russia-Ukraine. And then people started pulling out of the China deal because of the Russian invasion of Ukraine. And they dropped off. That's where it came from. Otherwise, in the first administration, those deals might have already held. Well, what's happening right now? Carney, we're going to reach out. Europe, we're going to reach out. Are we back in that same loop again, where Europe and others are like, okay, well, I mean, if this is, then we're going to reach back out to China. The US is a major consumer nation. I'm thinking about how, if there are secret microphones in here, I might get thrown out. Not of here, of my own country. Sorry, like I froze as I was starting to say that. I don't know how much the world needs the United States as a producer of items. They're going to be individual stuff, but that's not what we're known for. We're known for buying the stuff. Right? The renewable energy supply chain is already sort of, was starting to include a lot of the US. Now it's largely bypassing it. The center of the renewable supply chain is, or the universe, is China. Right? So I wonder, as this all takes place, if it reorients things in a big way, or if 4 years from now we've forgotten all about it, things have changed, we're holding hands, and we're right back to Canada, the US, Mexico, and now trying to create this whole thing together because we share land, and we should have been doing it in the first place. Yeah? Yeah, that's a big one. We have a question over here. I'll take. Okay.
Thank you, Rick. Great presentation, and I think kind of wrap up because of time. I don't know if we're going to have more questions after this one, but hearing you in the first part of your presentation, I got the feeling that you were kind of with cautious towards the markets because of what you mentioned of AI, of the labor market, etc. With this last part, with this answer of these last questions, I feel you are more cautiously but optimistic. Is that fair to say?
Yeah, I think I can be both. I think these last few answers are sort of cautiously optimistic for the world in pursuit of these goals around securing energy security and security to AI and access to what we think will be such an important technology. So in that respect, I don't look just at say the US. It's more of a collective optimism, I think. There's also a hopefulness that what I wished would be the way relations are within, say, North America would go back to being that way. But more specifically to labor and AI, in the first 3 years, is labor, I see a lot of little cracks forming in just US labor. And something can crack, but it doesn't have to break. But we're seeing a little bit of this and a little bit of that makes me nervous. And labor historically is also something that has momentum. When companies start to lay off, historically, others start to lay off behind them. It's almost like they get an excuse to lay off. That I've observed a lot in my couple of years. And so I'm nervous about labor for that reason. It's a tenuous balance. It doesn't have to happen, but that's what makes me nervous there. From an AI perspective, in the future, I think AI is, unless something changes, it's going to grow, get stronger. It's going to change forms, agentic AI, and then whatever's beyond that and beyond that and beyond that. But in the next 3 years, what we have is a lot of circular spending that's going from this AI entity to that AI entity, who passes it on to that AI entity. And instead, what I want to watch is net income. And we've started to see a significant uptick in debt issuance, bond issuance, to fund the next round of spending. Look, these guys are stuck. They have to spend. Like I said, this is an arms race. They have to spend. They're trying to stay ahead, get access to the data centers, lock it in, build them, have that ready. They're locked in. But how they fund it for the next 3 years is going to be interesting to me. Can they all successfully do that? Now we've got a 100-year bond issuance. If I remember correctly, the last 100-year bond issuance was J.C. Penney's, and it lasted like 20-something years and then went bankrupt. About 70-something years before it matured. It always makes me wonder when someone issues a 100-year bond, what the logic for that is. Like what the real logic, not what the explanation is. So it's funding AI and allowing it to grow and settle through all of this. You know, there's so many players competing, trying to get in, trying to change it. DeepSeek, I mean, it's like there's always going to be something. But the major players, the belief amongst a lot of us at AB and a lot of the senior tech guys is that the leaders 10 years from now are largely the same. These, like NVIDIA is still one of the big leaders, yeah? Now, yes, we can make a case for Chinese chips and some other things that come in the other way, for sure. But the belief is that there's a lot of flexibility when you're that large with that kind of cash that you can get access to and you're selling hand over fist, yeah? And over time, you can use that cash, you can use that power, you can lean on companies, you can acquire upstarts that might be a competitor. You have a lot of things that you can do to control your own destiny. So unless something changes the entire system of AI, let's say it becomes a China-run AI system, we go to that way, ASICs, whatever, the whole thing changes and the leaders all change. But unless that happens, and I think there are decent forces in the way of that happening, but unless that happens, largely probably a lot of the major players are still the major players. But even if they're not, eventually AI survives and it's you know, like this with us in human life. But over the next few years, we have to get past the costs of AI getting real, we call it ubiquitous use. There's 3 S-curves. So S-curve for those, like a business grows, sorry, I don't know how to do this. So there's an S. Business grows slowly, then it ramps up, and then as it gets mature, it slows again, shape of an S, right? So-called S-curve. We've talked about 3 S-curves. One is creating the data centers and training the models. That's the first S-curve. The second S-curve is ubiquitous use of AI. More and more and more and more people using it around the world, using it more often. More AI-related software, more AI everything, right? Ubiquitous use. And then the third S-curve is physical AI. If the second S-curve is all of us using AI, the third S-curve is AI going into the robots, it's going into the assembly plants, the factories, where they can troubleshoot the line while it's going on. It can order more stuff while the line is running. That Roomba, as I said on this one of my webinars, like AI gets inside your Roomba, and then my Roomba's going to tell me that my floor is so dirty that I need to clean it myself, and it refuses to vacuum my floor. But we put AI into the tech, right? All those have to, build and develop over time. And then finally, the biggest S-curve. This is the fourth that I don't talk a lot about, but this is the biggest S-curve. It's part of that ubiquitous use idea, the second S-curve, but this is what the tech buildup was. The real gains, for those of you who don't know, back then, the media started calling it the old economy and the new economy. The new economy was all the tech. The old economy was these lame old companies like Procter & Gamble and McDonald's or whatever, right? Those were the old economy. But all of the tech gains, that's who they accrued to. As time passed, the tech got used by every one of those companies, and most of the earnings accretion happened in the old economy adopting the tech. That's the same thing that we have to go through here, but this is a whole different time. Look, the 90s we had pets.com. Right? People thought pets.com was going to live forever. The little sock puppet commercials of the dog. No, terrible. That Pets is long gone. It's long gone. This is a whole different kind of a thing, right? But the biggest S-curve is when AI becomes widely used, understood, and adopted in corporations around the world to make operations more efficient, to add to productivity and margins, and really accelerate markets. The downside of that is it opens up a whole conversation around labor. Yeah. Because history says that in the past, all tech revolutions have not destroyed labor. It's killed some jobs and brought other jobs back, or brought in new jobs. And it's come out to be the same or more jobs created. The challenge or the issue I have with that is this is the first time that the tech thinks. It's a different animal for me. And we do have an example in history where tech has displaced living things. It's just not humans. In the Industrial Revolution, millions of horses were replaced. You can displace living creatures if what it is that that creature is doing can be replicated by the tech. By the way, the most insulting thing about it is like, as if it wasn't bad enough for the horses losing their job, we created a measure to tell them how many we were replacing through horsepower, right? The horses are like, this is the worst, 500 horsepower, God damn, right? Horsepower. We can and have replaced people. And I am in the camp that believes that AI does destroy labor. And that opens up a whole conversation around what happens in a world where now not everybody needs to work all the time. This is Owen's paper from 200 years ago in the Industrial Revolution. This is Keynes' economic possibilities for our grandchildren about a century ago. This is all the writings that are happening right now about what happens when we don't have to work full weeks, or what happens when certain jobs don't exist, and some of us don't have a job just because we're not needed. What does that mean? And now we get into universal basic income, and what does that mean for, that's a story that I'm going to put down there for now. But out of the gate, I do think that over time, the efficiency gains from AI as it goes forward is going to be transformative inside of markets. And when we get to that final S-curve where Procter & Gamble is a master of AI, okay, the S&P equities indices around the world will have done exceedingly well, because that's really margin enhancing, really margin enhancing. And theoretically, as the tech gets smarter and makes itself smarter, is it a self-reinforcing efficiency, right? And then the Terminator comes, and then we all get killed, and then the movie's over, right? But that's my take. So listen, I've gone far long enough. I'll hang around for any questions afterwards if anyone still has any interest in hearing what I have to say. But for now, thank you so much for spending the time with me. I really appreciate it. Thank you.
Well, thank you very much, Rick. Gracias a todos. Amazing presentation, really, really amazing. I mean, I could stay here for another 2 hours easily.
Thank you.
And again, glad to have the opportunity to have someone with this much knowledge and knowing that you're behind, one of the people behind of one of the big projects that we have with you, with the fund that is managed by AllianceBernstein. I'm sure there's going to be a lot of talk about this presentation. As you know, it's being recorded, and we're going to publish it to all of our clients, a big base of clients. And so if anyone here wants to come down and have a glass of water, a Coke or something, and talk a little bit more with Rick, you're welcome to do so. Thank you.
Great. Thank you.